What if I told you that two people could have the exact same portfolio, make the exact same return, and still end up with widely different tax outcomes? That happens all the time because building wealth is one thing, keeping more of it is another. And this is where a good financial advisor can bring real value, not by chasing the hot investment, but by helping you uncover tax strategies that create more flexibility, more control, and potentially meaningful tax savings over time. Today I want to walk through 5 of the biggest areas where tax strategy matters: capital gains taxes, the 0% capital gains bracket, tax loss harvesting, Roth versus pre-tax money, and one of the most overlooked opportunities for most people with company stock, a NUA. Let's start with capital gains. If you sell an investment in a taxable account for more than you paid, that gain may be taxed. For long-term capital gains, the federal tax rate is generally 0%, 15, or 20%, depending on taxable income. And for some higher income households, there may be an additional 3.8% net investment income tax layered on top. Now here's where strategy comes in. Let's say one investor sells appreciated shares randomly whenever they need cash. Another investor coordinates sales around income, retirement timing, and other tax events. Same investments, different tax results. To give you an example, someone retires at 58 and delays Social Security and large retirement account withdrawals. That gap period may create a window where their taxable income is temporarily lower. A financial advisor may help them realize gains in that lower income window instead of waiting until required distributions or other income pushes them into a higher tax bracket. And that leads directly to the 0% capital gains tax bracket. A lot of people do not realize this exists. For 2026, the 0% long-term capital gains rate applies to certain taxable income thresholds, including $96,700 if you're married filing jointly and $48,350 for single filers. That means, in the right scenario, someone may be able to sell appreciated assets and owe zero federal cap gain tax on some or all of that gain. Think about how powerful that is. Imagine a recently retired couple living off cash savings and modest income for a year or two. If their taxable income is low enough, they may be able to sell part of a brokerage account, reset the cost basis higher, and pay little to no federal capital gains tax in the process. That can make future withdrawals much more efficient. Next piece I want you to look at is tax loss harvesting. This is one of the simplest ideas conceptually, but one of the most valuable when done properly. Tax loss harvesting means selling an investment that is down, realizing the loss, and using that loss to offset gains. In some cases, losses can offset a limited amount of ordinary income as well, with the rest carrying forward for future years. Topic number 409 covers capital gains and losses more specifically. To give you an example, let's say you have a stock with a $30,000 gain and another holding with a $20,000 loss. An advisor may help you realize both strategically, reducing the taxable gain to $10,000 instead of paying tax on the full $30,000. That is not about panic selling, that is about turning market volatility into a tax asset. Now let's consider Roth versus pre-tax. This is where a lot of people make the mistake of thinking one is always better than the other. It's just not. Pre-tax accounts can be great when you're in higher earning years and want the deduction now. Roth accounts can be powerful when you want tax-free growth and tax-free qualified withdrawals later. Traditional IRAs and Roth IRAs are taxed differently, and IRA withdrawals before age 59.5 can also trigger penalties depending on the account and the circumstances. The IRS notes that IRA withdrawals can happen any time, but withdrawals may be taxable and face a 10% additional tax before the age 59.5. The real advantage is often not choosing one side, it is building tax diversification. To give you an example, if all of your money is pre-tax, every dollar you pull in retirement may increase taxable income. But if you also have Roth money and taxable brokerage money, you now have created options. One year you might take more from pre-tax accounts. Another year you might tap assets in the Roth to avoid pushing yourself into a higher bracket. Another year you could even use the taxable assets to manage those gains more carefully. That flexibility matters a lot when coordinating retirement income, Medicare premiums, Social Security taxation, and in general legacy planning. And finally, the NUA, or net unrealized, this is a strategy many people miss, especially if they have built up a lot of employer stock inside a 401k. In general, if employer securities are distributed as part of a qualifying lump sum distribution, the cost basis is typically taxed at ordinary income at distribution, while the net unrealized appreciation is generally not taxed until the shares are sold. This is IRS topic number 412 in publication 575. Here's why that matters. Let's say someone has $400,000 of company stock inside a retirement plan like a 401k, but their cost basis is only $80,000. If they were to roll everything to an IRA without reviewing the NUA option, they are going to lose that opportunity. But if an NUA is appropriate and handled correctly, they will only pay ordinary income tax on the $80,000 basis, and the other $320,000 of growth will later be taxed under capital gains rules when sold instead of it all being taxed as ordinary income. That could be the difference of 32% or 15%. That does not make it right for everyone, but for the right person, it can be a major planning opportunity. The bigger point in all of this is simple. Tax strategy is not just about saving money this year. It's about creating options both at now and in the future. Starting to think of when to sell, which account to draw from when to realize gains, when to harvest losses, when Roth dollars make sense, when pre-tax makes sense, and whether a hidden opportunity like an NUA is sitting in plain sight. This is where a thoughtful financial advisor can help by looking across your entire picture instead of making one decision at a time in a vacuum. Because it's not about how much you earn, it's about how much you keep, how long it lasts, and how much freedom your money gives you. If you want help organizing your investments in a tax-aware way and make sure your accounts are working together instead of against each other, talk with a financial advisor who understands how these pieces coordinate with each other. One smart tax decision may not change your life overnight, but years of smart tax decisions stacked together absolutely can make a difference. If you like this information today, like, comment, subscribe below.